Hey guys, Toby Mathis here, and today we're going to talk about three things to avoid in 2023. So let me lay it out real quick. What you have right now is the Fed's in what we call pivot, which means in December of 2022, they slowed down the rate of interest rate increases. And so what we know for sure, and let me just make sure I have the actual dates, it's going to be February 1st, March 22nd, or May 3rd. You're going to have more Fed meetings. At some point, you're probably going to see a pause of interest rate hikes, which means they're eventually going to stop. I don't know when it's going to be. It will more than likely be in 2023 where they stop. They won't be lowering interest rates, but they'll probably stop raising interest rates. And I think the market is thinking it's going to be by May 3rd. But regardless, what we have is the Federal Reserve has been raising interest rates to try to stop inflation. And you've heard me talk about this before. It's the money supply in my mind that caused the inflation. So they're doing something called quantitative tightening, where they're taking money out of the society, where they were dumping trillions of dollars. I think it was over $4 trillion during the pandemic that they poured into the economy, which devalued dollars, which spiked inflation, right? And now they're starting to pull some of that money out. And in the meantime, they're going to beat up the economy. They're going to cause pain. And I would say we're probably 100% likely to be recession. The Fed's really good at doing things. They have almost a perfect record at causing recessions when they want to, because they're just going to keep increasing the pain until we can stave off some of the demand. And again, you've heard me talk about the misnomers in the real estate market. We're at 5 million units underbuilt and those types of things. Demand's not going to stop, right? What they're going to do is make it really hard to get a loan and that's how they're going to stem it. And they're going to cause people to lose their jobs so that they can't buy a house. We'll see how good they are at doing it. I'm not going to bet against the Fed at causing economic carnage. I just don't know how married they are to destroying the economy. But regardless, what we do know is that they've slowed, as of right now, at the end of 2022, they've slowed the rate of increases. And hopefully they continue doing that. And then eventually they stop it altogether in 2023. So what do you do in 2023? I'm going to tell you three things to avoid. But this definitely sets out where we are. Now, when you have rising interest rates and making money more expensive, some of you guys are probably scratching your heads going, well, I don't really have any debt. It doesn't affect me. There's a lot of truth in that, right? There's certain people that it doesn't affect them. There's certain businesses that are cash flow businesses that don't rely on debt, and they're going to be fine. And so this is where I'm going to say the first thing you avoid is the ones that it does impact. And those are our friends, the growth stocks. You guys know me. I tend to avoid growth stocks anyway. Like, it's betting, it's gambling in my mind. But these are companies trying to grow, and they're taking on mass amounts of debts. And if that debt's more expensive, I think Warren Buffett put it really well. He goes, raising interest rates are like gravity. And what was happening is when the opposite was true, when there was low interest rates, then these companies were bounding up, and jumping really high, and they look really great because they're getting really cheap, sometimes practically free money. Once that money becomes more expensive, now it's bringing them back down to earth, and it's putting weight on them. If you are a strong company and you don't need that debt, you're not really impacted by the interest rates, then it's not going to impact you much. So I would avoid growth stocks as my number one rule now. Any company that these raising interest rates is going to have an impact on their business, they're going to get brought down to earth, and they're going to get slaughtered in the market. I mean, they already have, and they're going to continue to. On the converse side, what you actually look at is you start looking at strong companies that have a moat around them. Like again, I could rattle off names at you, but you already know what they are. Is companies that doesn't matter whether the economy is going up or down or sideways, people are still going to use. They have a competitive advantage, and they have brand recognition, and they're just really good, and they have lots of cash flow. We call it free cash flow, and they reward their shareholders by issuing out dividends. So I tend to focus on dividend kings and aristocrats, the companies that have been paying out increasing dividends for 25 years or more, some cases 50 years or more, because we've seen them go through bad economic cycles. They've all gone through the recession, for example, and they continued to pay more to their shareholders. So to me, I look at those, but I avoid growth stocks. I would just say that the higher the interest rate on those companies, and it's a material part of their business, the higher their cost, the less money there is for shareholders, the less value they're going to have in the marketplace, and people are going to run to bonds and other things as the interest rates increase. It's just not going to be worth it, and you're going to see the growth stocks continue to get pounded. Number two, avoid sticking money in a checking account, because the reason they're raising the interest rates is to combat inflation, which is still ridiculously high, right? So your money is melting as we speak. If you have money sitting in a checking account, it's literally melting. It's becoming less valuable every day. Don't do that. If worst case scenario, stick it in a money market, put it in a savings. I'm sure you can get up to 3 to 4% now. Something so that it's not melting as fast. Like inflation's still higher than those. And that's what, that's what the Fed's trying to do is get it more on par. And I don't know why they always pick like 2%. I think they pick that stuff out of the air, but maybe they'll adjust and pivot a little bit and start saying, hey, we're okay with 4% inflation, depending on how much decimation they do to the market. Eventually the stomach to continue to damage the market under this auspices of reducing demand is probably not going to be there. The public outcry is going to be pretty strong in 2023. At some point, you're going to see them say, oh, maybe it was the money supply, and they're going to continue to do some quantitative tightening on those things. But, just for kicks and giggles, if you're a charting person, just look at the Case-Shiller index and put it right next to them to money supply. They're almost identical. Like the price of houses went up because the money was devalued. Cash was devalued by the money supply. It's almost identical. Like you can just watch it. They track each other. They go boop, 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 right? It's eerily similar, right? But let's not talk about that. Let's talk about other things. So don't put money in just cash. And if you do have money in cash, make sure it's in a savings account or a money market, something that still, you don't have to put it in the market. If you're scared of the market, I get it. But you definitely don't want to just have it sitting there in a checking account being devalued. Last thing you don't try to time it. I see all these people out there, 2023, sell everything. Don't panic sell. Never ends up good. I used to have this weird rule. I would go out and I would talk at conferences, and a lot of them were stock trading. I'd never meet somebody that just lost like a little bit of money. They'd always lose hundreds of thousands. And it was always because they completely, like they got greedy, and then they panicked and they sold off, and they weren't able to stomach or continue to hold on. If they were option trading, they were just gambling. So they would lose their money at the table. I live in Vegas, so I can relate to that around here. See a lot of people that go out and lose their money at the table. Don't gamble. You want to be the casino, right? But do not sit here and think that you're the crystal ball gazer. There's never been anybody who was a crystal ball gazer. Don't try to time the market. Study after study. And there have been great studies from Schwab, Bank of America, etc., who've done these big elaborate studies to show you're better off 99% of the time just consistently investing in good, solid companies. Or if you don't know good, solid companies and you don't want to learn good, solid companies, just do a low-cost index. Just invest regularly. Don't try to time it, because you're going to be way better off. And I think that there was one study I saw where there was the perfect investor, where they invested at the bottom of the market every time, and they were about 10% higher than people that either invested all at one set point or who consistently, they call it dollar cost averaging, just consistently bought the market. And it was so close, but they were way ahead of everybody else. Like those three categories was either invested all in one big tranche, consistently invest, or you were the number one, like you had a crystal ball and you managed to invest every time the market was at its lowest. You barely beat the people that just invested routinely. Barely. And guess what? There's nobody who has that crystal ball. And probably the best investor of our time, Warren Buffett, is a classic example of someone who buys good companies consistently over time and doesn't stop, just consistently buys. And I think his advice to people is pretty solid, which is, there's the be greedy when others are fearful and all that good stuff. Be fearful when other people are greedy. That's the flip side to that, which right now, what are we in? We're in a lot of fear. So be a little bit greedy, start looking for good companies. Something he also said was he likes his stocks like he likes his socks. He likes to buy good quality at a discount. This is a good time to be looking for those discounts. So he would say, buy really good companies consistently over time. And I happen to agree with that because I look at my affluent clients who consistently make great money over decades, and they all do the same thing. So I'm like, okay, I can do that. I'll just consistently be buying. And if you don't know what's out there in the market, and you don't want to try to pick out, hey, where's Coca-Cola, Procter and Gamble, 3M's, and Starbucks, Costco, Walmart's, whatever. You don't want to dig into some of these companies that you use on a consistent basis. Maybe you just want to hey, SPY. I just want to buy an index. Okay, go do it. Just consistently do it, and don't pretend like you're the smartest investor out there. And now I'm going to put a couple comments here, because you're going to see people, I'm killing the market, and they're going to post their returns and all this great stuff. I doubt they'd be doing that if they were actually consistently making great returns, but that's just me. I could just tell you from looking at tens of thousands of tax returns over the years of affluent investors, the ones that consistently make great money, they're boring. Buy consistent, put it on autopilot, just keep doing it. 2023 is not going to be any different. I think the market's going to be beat up for a while, but eventually you're going to see that pivot where the Fed stops raising interest rates. And it's usually within 6 to 9 months that you see the market just reward everybody, right? But we don't know when that's going to be. It might not even be in 2023, right? But what you want to do is consistently be buying so that you're participating when it does happen, because it will eventually happen. In the meantime, the Fed's going to increase the pain. They're going to keep increasing the pain. Last things I'm going to say is the tax code tells us what to invest in. Consistently, taxes are built around incentivizing certain behaviors. And one of those behaviors is capital gains. Another one of those behaviors is dividends. So I would be buying good companies that pay a decent dividend, over 2%, 3%. Again, you can look at the Altrias where it's really high. Verizon's been beat up and still has a high interest or a dividend rate. But you look around at companies that like to reward their shareholders, and what you don't realize is that those dividends that they're paying out to you, quite often they're at the 0% tax bracket, depending on what your income level is, because they're taxed as long-term capital gains. So there's a strong tax incentive to be doing it. Plus, if I have this stock portfolio, a lot of people don't realize is as they build it, that's no different than having a house. You can borrow against it. And if you wanted to go out and do things, send someone to school or whatever, you don't have to sell your portfolio to get access to capital. If you did, it's still treated as long-term capital gains, which is 0, 15, or 20%, depending on your tax bracket. But what you always hear about is buy, borrow, die as being the rich tax technique for never paying taxes. And there's a lot of truth in it. We saw some tax returns of some very wealthy people floating around out there. You're not supposed to, but somehow government agencies managed to release some. But what you see consistently is this idea of buying capital assets, letting them appreciate, and then accessing that capital via loans, which are tax-free. And if you ever do have to sell it, it's usually about half the rate that you would pay otherwise if you were earning that income, especially if you were earning the money as wages and you had self-employment tax or Social Security taxes plus federal income taxes. It's considerably higher. It could be more than half or more than twice as much. So capital gains are our friends. So the tax code is telling you invest in companies that pay a dividend and hold on to them for the long term, and don't sit here and try to time the market. allow things to accumulate over time. The tax code's telling that, and history is telling us that. And so I would just say, again, if there's three things I'd be avoiding, it would be again, don't mess around with growth stocks this year for sure. Probably never. I'm just not a growth stock person, but this is a strong case right now. Is it's never been like this is probably one of the worst times you could. Don't keep your cash sitting in a checking account. Make sure you're earning something on it, and do not try to time the market if there's like the things. And then the freebies is listen to the IRS. Don't listen to the talking heads on TV who are always trying to agitate. I mean, Wall Street makes its money on activity. You make your money on inactivity. If you just understood that simple principle, that the longer you can not do something, you just keep buying things and keep holding it, the better off you are at just buying and holding, the better off you'll be. It'll drive them crazy, but they're out there on TV constantly agitating the markets. Oh, this is going to go up. Oh, you need to dump this or this. Don't do that. And if you think the professionals make great money doing that, all you have to do is look at the Spiva studies, which shows that over a 15-year stretch, not even 10% of professional money managers beat the market. The market still wins more than, I think it's 92% of the time, which means all these people that make their living, they don't beat the index. They don't beat the baseline. Just buy the index, guys. If worst case scenario is just buy like SPY, just sit there, just keep buying it, and you'll be just fine. So 2023 might freak you out a little bit. Just remember, take that right hand, stick it underneath that right butt cheek. Take that left hand, stick it underneath your left butt cheek, and wait. Don't panic. Don't do crazy stuff. Continue to consistently buy, and you'll be rewarded over time. It's going to be a weird year. And there's people going to be, the sky's going to be falling all the time, or it's going to be, hey, we're through it, and it's going to be this huge rush of, hey, it's going to go back up, and you're going to have this huge rally or whatever. Everybody's going to be telling you these things, and it's going to trigger a greed instinct in you and fear of missing out. Don't just remember, sit on those hands consistently. Put your plan of action in place. And work it, and don't sit here. Like, better off, like, don't watch cable TV during the year, and try not to keep reading up on it, and just consistently buy, and you'll be rewarded over time.